Right now, roughly 7 million American households have no bank account, zero. Many people assume that means those families do not save money, but that assumption is wrong. A survey of households in Houston found that more than half of residents without bank accounts were saving money anyway. The real question is not whether poor families save. It is where that money actually goes. The answer is a whole parallel system. Cash is tucked inside mattresses, walls, and freezers. Savings are held by a trusted aunt or a cousin down the street. Neighborhood lending circles let families pool money and take turns receiving it. Prepaid debit cards work as makeshift bank accounts. Check cashing outlets charge people to access their own paychecks. This system has its own logic, its own rules, and its own long history. It did not appear by accident. It was built piece by piece over more than a century because the formal banking system was never really built for the people who needed it most. To understand why this parallel system exists, you have to go back to the Great Depression. Between 1930 and 1933, more than 9,000 American banks failed. When a bank failed, the money depositors had trusted it with was simply gone. There was no insurance, no government guarantee, and no safety net. 1 out of every $3 held in American bank deposits during that period was wiped out. People who had worked, saved, and handed their earnings to a teller for safekeeping walked up to locked doors and found nothing. The people who kept their savings intact were often the ones who had not trusted banks at all. They kept money at home, sewn into hems, nailed inside walls, or buried in the yard. They watched their neighbors lose everything. The lesson passed down through families was simple. A deposit is not money in storage. It is a loan to the bank, and the bank can fail. In 1933, Franklin Roosevelt's administration passed the Banking Act, and the Federal Deposit Insurance Corporation, the FDIC, was created. The government would now guarantee bank deposits. If your bank failed, you would get your money back. That was real, and it worked. For most Americans, the bank run era was over. Middle-class families moved back into banks, and they stayed there. But the story splits there. The FDIC fixed the fear of bank collapse. It did not fix the cost of using a bank if you were poor. To open a checking account, many banks required a minimum balance. If your balance fell below that threshold, they charged a fee. If you spent more than you had, they charged an overdraft fee. Some accounts required a social security number and a clean credit history, which recent immigrants and informal workers often did not have. So the FDIC put a seal on the door that said, your money is safe here. But for millions of families, the door still would not open. They stayed outside and kept storing money the way their grandparents had. Then came the 1980s and a new problem that had nothing to do with bank failures. Banks left. Deregulation made it legal and profitable for banks to consolidate, close low-revenue branches, and chase wealthier customers in wealthier neighborhoods. The branches that closed were almost always in poor neighborhoods. In New York City, the poorest boroughs lost a disproportionate number of bank branches through the 1980s and 1990s. The banks did not vanish entirely, but the nearest branch moved from 3 blocks away to 3 miles away, or required a bus ride, or simply did not exist within walking distance. Into those empty storefronts came check cashing outlets, pawn shops, and payday lenders. In New York State alone, the number of check cashing outlets grew by 44.5% between the early 1980s and the early 1990s, from 353 locations to over 500. These businesses offered real services: immediate cash for a paycheck, money wire services to send funds abroad, and short-term loans without a credit check. For a recent immigrant who spoke limited English, a gig worker without a steady employer, or a family without a permanent address, these outlets were functional, but they were expensive. Check cashing fees typically ran between 2 and 5% of the check amount. On a $1,000 paycheck, that is between $20 and $50 gone before you buy a single thing. Multiply that by 52 weeks and you are paying between $1,000 and $2,600 a year just to access your own income. A person with a free checking account pays nothing for that same access. So where does the money actually go? The most common method is the one that gave this whole phenomenon its name: cash hidden at home. Under the mattress is shorthand, but the reality is more varied. Bills are folded inside envelopes taped to the back of dresser drawers. Cash sits in fireproof bags behind wall panels. Rolled currency rests inside coffee cans at the back of kitchen cabinets. The logic is simple. The money is immediately accessible, and there are no fees, no minimum balance, and no paperwork. The risks are also simple: fire, theft, and the slow erosion of inflation. Cash sitting still loses around 3 to 5% of its purchasing power every year, which means $1,000 in a drawer in January is worth roughly $950 to $970 by December from inflation alone. The second method is the family network. One trusted member of the family, often an aunt, grandparent, or sibling, holds savings on behalf of others. It works because the relationship carries stakes beyond money. You do not steal your sister's emergency fund when you will see her at Thanksgiving for the rest of your life. The risks here are relational rather than institutional. Disputes, the holder's own unexpected needs, or death and illness. But for families with no other option, the network functions as a private, zero-fee savings account backed by trust instead of insurance. The third method is the rotating savings and credit club. Different cultures have different names for it. In West Africa, it is susu. In Latin America, tanda. In Korea, gai. The mechanics are the same. A group of people, often neighbors, co-workers, or members of a church, each contributes a fixed amount every week or every month. The total pool then goes to one member. In the next cycle, it goes to another. Every member eventually receives the full pot once. No interest, no fees, no credit check, and no bank involved. For someone who struggles to save alone but can commit to a group, social obligation makes saving possible. The community holds you accountable in place of a financial institution. The fourth method is the prepaid debit card. This became widely available in the 2000s and filled a real gap. You load money onto a card, spend from it, and reload it. No bank account required, no credit check, and no overdraft. But prepaid cards have fees too. Monthly maintenance fees, transaction fees, and ATM fees. They are better than check cashing outlets for ongoing use, but they are not free. Think of them as a bank account with some of the convenience and some of the cost, but still a cost that a standard checking account might not charge. Then there is the check cashing outlet itself, which functions as the de facto bank branch for unbanked households. Beyond cashing paychecks, these outlets often handle money orders, bill payments, wire transfers, short-term loans, and sometimes prepaid cards. They are a full-service branch replacement. They are just expensive to use at every step. Every one of these methods works. That part is important to say clearly. These are not signs of ignorance or irrationality. They are functional responses to a system that priced out the people who needed it most. But functional does not mean free. The mattress economy charges its own kind of fee, and the bill comes in forms that are easy to overlook. Cash at home loses value to inflation every year. A robbery near a check cashing outlet can erase a month of savings in 30 seconds. Family disputes over pooled money can split households apart. The biggest hidden cost is the one that compounds over decades. Without a bank account, you do not build a credit history. Without a credit history, you cannot qualify for a mortgage. You cannot get a car loan at a reasonable rate. You cannot access the financial infrastructure that the middle class uses to build assets over a lifetime. The parallel system keeps money safe in the short run, but it walls people out of the long run tools that build generational wealth. That is not an accident or a personal failure. It is a structural outcome. The formal system made itself inaccessible to a group of people. So that group built something else. It works, but it costs more, and it does not lead anywhere bigger. Where does this leave us today? The 7% national unbanked rate does not sound enormous until you zoom in. In cities like Houston, the rate reaches 10%. Among black households nationally, it is closer to 12%. Among Hispanic households, it is around 9%. These are not small numbers, and they have not collapsed even as digital banking has grown. The check cashing industry now wraps itself in fintech language. Cash apps and payment platforms serve some of the same functions that neighborhood outlets did, and a few do it more cheaply. Some banks now offer second chance accounts for people who were previously rejected because of overdrawn accounts or bounced checks. These are real improvements. But the underlying dynamic has not changed. Formal banking still costs enough to push some households out entirely. The transmitted cultural memory of bank distrust has not evaporated either. The families who lost deposits in 1932 and whose children grew up watching a parent hide cash in the walls passed down a lesson that outlasted the crisis that created it. That memory is real, even when the risk is different now. Today, a federally insured bank account is genuinely safe up to $250,000. The danger is not bank failure for most depositors. It is the fee structure and access barriers that make the formal system feel like it is not for you. Historically, it often was not. So when you see a household with no bank account, the easy interpretation is that they distrust banks for no good reason, that they made an irrational choice. But the fuller interpretation is different. More than 90 years ago, 9,000 banks failed and took a third of American deposits with them. The government then built a safety system that protected most people but priced out the poorest. Banks deregulated, abandoned low-income neighborhoods, and left behind an industry of check cashers that extracted fees at every transaction. Families who had been burned or who had inherited the memory of being burned built their own system. They hid cash at home. They pooled money with kin. They passed envelopes around a kitchen table on the first of every month. The system they built is older than most living Americans, more widespread than most people realize, and more rational than it looks from the outside. It just costs more than the alternative they were never fully given access to. The poverty premium is not only in the paycheck, it is in the price of keeping your own money safe.